In this video, a simple staking strategy for anyone that holds crypto. There are 3 ways to stake. Each of them pays slightly higher yield and carries with it slightly more complexity. We can all choose which method that we want. Timestamps for that below. Firstly though, I want to explain why staking. I'm going to show you a real example here of BNB coin and why staking increases your bags. This is the price of BNB, as you can see right now. We're in the bear market now. So let's just go through an example. During the bull market or previously, you bought $10,000 worth of BNB coin when it was at $400, and so you got 25 coins. That's a $10,000 investment. Let's say the price in the bear market falls to $250. We still have the same amount of coins, and multiplied by the price per coin, this is now our total holding in dollar terms. We've lost money in dollar terms. But you can wait till the next bull market, and so you still have the same amount of coins without staking, goes back up to 400, you make your money back. You've just held through a bear market for almost 2 years and you've made nothing, right? You've just made your money back. So not great. So why stake? Staking is just taking yield from staking on the blockchain. The coin itself pays a yield, that's back to you. It's like dividends from a stock. Some of the profits go back to you. And so you're just increasing the amount of coins that you have by investing in staking. So we make the same $10,000 investment at 400, we get 25 coins. We then stake those coins for 18 months through the bear market at 10% yield, 10% per annum, which over 18 months works out about 15%. And so we've got 3.75 more coins. We now have more coins. At that $250 price, we now have more money because we've taken some of that yield. Okay, we've earned yield from investing because Binance Smart Chain is a profitable protocol. So it passes that dividend back to us. If we go back to the same price as we had before at 400, we've now got more coins at that price, and it's obviously 15% more. So as you can see, staking, just you earn dividends and staking rewards from the protocol. It's a little bit more complex than that, which I explained through this video. When setting out a staking strategy, the main thing for me is do not choose anything based on its yields. You have to invest in the protocol that is profitable and a long-term winner first, and then the staking is second to that. Staking is good and it's a bonus, but you must choose, at least in my opinion, a profitable protocol first. High staking rewards means there's something fishy going on. I'll show you why. So ADA is an example here. ADA actually stands out as a great example because it has a really amazing inflation schedule, which is just like Bitcoin's, but it's proof of stake. What is staking? Staking is where new coins are created and given out to people. Now, this is not real yield. Real yield is when a protocol charges fees to use it from customers, and some of those fees are passed back to you as an investor. So at the moment, the inflation rate of Cardano, just as an example, let's call it around 3%. That 3% though is from the creation of new coins, okay? So this protocol, out of thin air, every epoch, just creates some new coins and hands them out to everyone that's staking. So if it creates 3% new coins and gives them to me, I'm 3% richer. But if it gives 3% more to everyone else, then we're all even. No one's richer from doing that. So you do not get richer from inflation. Inflation is a bad thing. As you can see here, if you have a piggy bank that's worth $1,000, Cardano is worth $1,000. You have 2 shares or you have 2 tokens. Each of you has $500 worth of the protocol. Let's say you create new tokens out of nowhere, but the piggy bank is still 1,000, then obviously you just have twice as many coins, but they're the same value, and so they're 250 each and not 500 each. So the creation of new coins through inflation is not passive income. So when you see a new protocol that says we're going to pay you 50%, 80%, where is that yield coming from? The creation of new coins, dilution, inflation is a bad thing. So what we're looking for is real yield. Now you can very easily look this up. This is Cardano's supply schedule. As you can see, in the start of every protocol will be high inflation to make sure people try and join the network and stake, because staking is a security and consensus mechanism as well. As a protocol matures, it must have low to zero inflation so that it can pay you a real yield, and that is profit. You can go to stakingrewards.com, look at all of these protocols, see how much they pay. They've recently added something really good, so I'm going to click on Ethereum, and it will show you the real yield here. What you can see is reward and then adjusted reward. Adjusted reward is adjusted for inflation. So what is that? What is that actually? Yield minus inflation is the real return that you get. let's say inflation, and this works with the dollar as well because we're high inflation now. Let's say inflation is 10% and the yield that you get from a treasury for investing your dollars is 3%. What's the real return? Minus 7%. You are losing 7%, even though you're getting yield. Because the inflation rate is higher, you are losing purchasing power. If the yield is 5% and the inflation is 1%, you are making 4% real yield. That is a plus. So you need real yield, not through inflation. Take that into account when looking at protocols in terms of high yielding protocols. You don't want those. We want profitable quality protocols that make money. Which protocols are profitable then? Well, that comes down to research. As you can see here, we can go through the list of top 10, top 20, top 30 coins and see which ones are profitable, which ones still have inflation left. Come up BNB coin as well. Look to see if there's inflation or not. You can see there's no inflation for BNB coin, but it pays a yield. And so you know essentially that that yield is real yield. I can't go through all of the coins here, but a little bit of research to show how mature is an ecosystem, how much does it make in fees, and how much does it pay out in yields as well. So you can work that real yield out. You can go to stakingrewards.com. You can also go to a platform like Crypto Fees, which will show you how much money each of these protocols actually earns. And you can work this out very easily in terms of a yield about how much they're paying out versus how much the yield is. And you can very easily work out, was it real yield or is it being paid by staking rewards? And then you can see how many tokens are left to be issued or not, as the case may be. We want profitable protocols. I can't go through research and everything in this video. I do have my crypto course. If you want to get a bit more pro on your research here, we have a whole DeFi section going into how to get yield and how to invest in staking and everything like that. Also, there's a Discord group where people put their research as well. So check that out if you want to get a bit more deep into the research and actually finding out which profitable protocols there are. The first method of staking, though, is on-chain staking. So every single crypto will let you stake them on-chain. It depends on the crypto. Layer 1 blockchains will do this. Tokens or applications don't have their own blockchain, and so you may have to go to the application to stake. And actually, applications may have different ways of providing yield, not just giving you more tokens from profits because of the issues around securitization there. So on-chain staking, really, it doesn't matter what protocol that you're using. All you have to do is say, where is the protocol or where is the application? Which blockchain is it on? And then you can go from there. So if you're an investor, you take the coin of the blockchain, or if it's an application, you need to know which blockchain it's on, probably Ethereum, and then you can go from there. So if you have BNB coin, what you do is go and find the native wallets here, which is Trust Wallet and Binance Wallet. If you have Cardano, you go to something like Yoroi. If you have Solana, you go to something like Phantom. And if you had an app token like Uniswap or Aave, you have to go to those applications here. That would be Aave. You go to the Aave protocol, and there will be a staking or some sort of governance area of that site, and then it will tell you how to stake. Now, that staking may have other risks. App tokens, like I said, may pay out through different procedures because of securitization. So they may be paying you out to take a little bit more risk or to make other traders whole if there's some problem. So beware of DApp tokens. They may pay a yield, but there may be some extra risks there. With layer 1 tokens, you should be being paid out by either inflation, real yield, or a mixture of fees and inflation. All you do once you've found the native wallet, though, for layer 1 blockchains is essentially just go and stake it in the wallet. And I have specific video guides for the vast majority of L1 tokens, which I will leave in the description if you want to go ahead and actually stake each of those coins. The other thing to do is simply to go to Binance Earn, and just see if you can earn passive income here. Now, this might be good for beginners. I personally do trust Binance, but obviously this is centralized, and so you will have to put your coins on the exchange. But let's say, for example, we want to stake Cardano. So we look for ADA and we see what the yield we can get here is. Now, Cardano ADA pays around 4% yield on the blockchain. You can see Simple Earn pays around about the same. So for investors that are new, or if you have smaller amounts of ADA, you may just want to put it on here. It's easy, and you can subscribe and earn that yield, but you have that centralization risk, even with Binance, which is the most profitable, largest platform in crypto. That's centralized. Whereas if you just take a little bit more effort into downloading a decentralized wallet and setting that up, you can get your ADA in there and then go and stake. If you want to know how to stake any coin, again, like I said, links in description to those specific videos. On-chain staking is layer 1. That's the lowest yield you're going to get. That's direct yield. Nothing's happening except for the blockchain paying you out that yield. And so the only real issue here is if your own wallet gets hacked, and that's down to user error. So there's no centralization here. You are staking right on the blockchain. Now, layer 2 is known as liquid staking. This happens for a lot of different chains, mostly EVM chains like Ethereum, Binance Smart Chain, Polygon. Solana do it as well, though. Liquid staking is where you introduce a player that writes smart contracts that makes staking easier. Now, when you stake, there's a few downsides. The first is lockups. So you'll get anywhere from a 9 to 20 day lockup, something like this, which means you can stake your coins, but if you want to get them back, you have to wait 9 to 21 days. Not very good. What you can do is actually use a liquid staking provider. Now, what these guys do, let's say you're an investor, you can take a coin like Ethereum and you say, I don't want to lock it up, but what I want to do is stake it and earn that yield. So you take your Ethereum, you give it to someone like Lido, and they go and stake it for you. They then give you a new token called Staked ETH. This pays the staking rewards to you, about 5%, but now you have a token that isn't locked up. You can trade it immediately on the market. So think of this token as a brand new token that is Ethereum, staked Ethereum that pays you the yield. But if you want to get rid of it right now, just go to a decentralized exchange or go to something like Bybit and trade it out for US dollars or USDT or anything instantly. No lockups. Now for this, they take a small percentage of the profits. You can do that for other chains as well. For example, Binance, BNB Coin, they use Anchor and they use Stader. They'll take a small fee, 10%, and pass the BNB staking rewards back to you, around 5%. You now have a token that you can trade in and out of very easily, and importantly, a token that you can use across DeFi. You don't have to use it across DeFi, but if you use a liquid staking provider, you can get the yield straight in your wallet, and it's an easier process. I'll show you how this works. This is Lido right here, so the most popular platform for this. You can see the coins that you can stake. All you have to do is get a wallet like MetaMask or Phantom Wallet, go to stake now, and that just says connect wallet. So you can connect wallet up here and you stake your coins. It's a blockchain transaction like anything else. You need ETH. They'll swap it into staked ETH, and that's that. You have that staking coin that's accruing the rewards, and also you can trade out of it whenever you want. With liquid staking, you're not increasing your yield at all, but it creates an easier environment for you. So again, you're still at the same yield as on-chain staking would be, more or less. Now, there's another way to increase your staking rewards when you're using liquid staking derivatives or any other type of staking coin. You can use DeFi. With DeFi, you provide liquidity or you lend out those coins that you're staking, so you have yield upon yield. This is very briefly how it works. I have other videos on this that go through it much more in depth. But for example, with BNB Coin, you're an investor, you put your BNB with one of these liquid staking providers. They give you one of these liquid staking coins, which you can now go and use across DeFi. How would that work? As you can see here, this is a liquidity pool, and it is a liquidity pool between the staking derivative and the layer 1 coin. Now you can see the APR here is 11% because you are getting cake yield, which is an incentive from the DEX, and you're getting an LP yield as well, which are the fees that you get from other people that are paying fees to trade. So you're getting staking rewards from this token, plus some fees from the DEX as well. And that is extra yield. Now you've got the same underlying exposure, but you're making higher yield. Now what you can do here is use a protocol like Beefy or Yearn Finance or other providers that do this. And what they do is essentially take these coins that you put in and they automate the yield strategy for you and then pay you the yield out. And you can see that overall with this strategy, it yields 9.67%, which is around about double or more the actual base yield of Binance Coin if you staked it yourself. Now, what you're doing here is actually increasing smart contract risk. So you're taking BNB Coin and you're introducing these smart contracts, which is another risk. And then you're putting it on PancakeSwap, which is another smart contract risk. And then you're putting it into Beefy, which is an aggregator, which is more smart contract risk. So as you can see, with extra risk and extra complexity does at the current time come extra yield. Everyone can choose where they're comfortable with this. Either just going on chain, taking a lower yield and saying, I don't have to do anything, I don't have to worry, or all the way up to this, which pays more yield, is slightly more complex. Tutorials for all of this are in the description if you want to see how it works anyway. If you're looking for a much simpler guide, my crypto course has much simpler bite-sized videos here that go step by step through all of the basics that you would have to know to actually go through with investing in DeFi and putting a portfolio together. So that might help you out a little bit more in this video. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.